Alphabet reports earnings after the market closes on Tuesday, and there's going to be a ton of attention on the company's cloud segment. That's where the artificial intelligence business is housed. So there's going to be a lot of attention on not only revenue growth, what is the traction there, are startups building on the Google Cloud, what do margins look like? It has now become profitable over the last few quarters. But I think the most important thing for Alphabet is going to be the search business, the old school search business, what Google was built on in the first place. The story 18 months ago was that ChatGPT and artificial intelligence was going to fundamentally disrupt the way that we interact on the internet. It was going to destroy the search business. That has not been the case, and the numbers bear that out. And if this starts to be a growth business again, which I think it could be, then this is arguably one of the most attractive stocks in the big tech space. It has the lowest price to earnings multiple of all the big tech companies. I don't think there's a lot of growth priced in right now, despite the fact that it's actually growing more than a lot of its larger competitors. So I want to go through why I think this is the most important business and a couple of numbers that investors should be looking at, because the results are a little bit convoluted with Alphabet. So I want to go through this segments and what you should be looking for. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look first at the two numbers that I'm going to be looking at first. This is a chart that shows Google search and other revenue. That's the big segment that they report. That's in blue. And a couple of things that I want you to note here. You have early in the pandemic, there was a pullback on spending. So the June 2020 quarter was a little bit of a weak quarter. Then you have the explosion in online advertising as everybody was spending their money online and not in real stores up to the December 2021 quarter. That's when you start to have an impact from Apple's app tracking transparency. What that was it broke the tie between a click on an Apple device, particularly in apps, app tracking transparency, and a purchase that was made on the internet, whether that was in another app or whether that was on a website. There used to be a direct tie. The merchant, the advertiser, knew exactly what happened from the point of that initial click on an advertisement to if you actually made a purchase, because advertisers are more than willing to pay for clicks if they lead to conversions. So this was a phenomenal way to do advertising and build an advertising business. The two companies that were the most impacted by app tracking transparency were Alphabet, Google, and Meta Platforms, Facebook. So they had a short-term impact until they changed their way that their back end worked, where they could now probabilistically say, you know what, you probably made a conversion based on the other inputs that we have into the system. This is one of the reasons that a lot of these aggregators have been buying companies that can actually complete that purchase for you. So just a really, really high level background on what was going on there, but that's why you see revenue start to flatten out starting in 2021. That was not the impact of ChatGPT. That did not come out until 2022, later in 2022. So you see those flat results. But what have you seen over the past 3 or 4 quarters? You're starting to see growth. You're starting to see year over year growth. I'm going to show this in another way with trailing 12-month numbers. This shows this a little bit better. You can see that the trailing 12-month numbers really flattened out from middle of 2022 through really middle of 2023, but over the last 3 quarters, we've seen some nice growth there. So does that continue in the second quarter of 2024? I think it will. I think that search has continued to be extremely strong. It continues to be the place that I go to find anything that I need on the internet. I don't think artificial intelligence has really replaced that for most things. So this would just solidify that Google's core business is going to remain really strong. The orange column that you see is their operating income. And what they do is they report Google Services operating income. So this includes not just search, but YouTube, their networking services. So a lot of other things are included in here. They break out revenue in more segments, and then they report operating income in a smaller number of segments. So I think they should be breaking this out in a little bit more detail. But this is what we get from investors. So you can see there, those margins went down pretty significantly in late 2022 and into mid 2023, and now are at all-time highs. So they had some layoffs, had some cost reductions, now over $100 billion in trailing 12-month operating income from that business. So if that continues, that's going to be very strong momentum for the business. Now, this is going to be the thing that I am going to focus on, because if the core search business and all the businesses that go into this services operating revenue, so search, YouTube, networking, if all of those businesses continue to be very strong, which again, I think they will be for Alphabet in particular, but will be for big tech in general. The other thing that investors are going to be keeping an eye on is artificial intelligence. So it's worth going over those cloud numbers and what those look like, what the bar is set at for Alphabet. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This chart shows the trailing 12-month Google Cloud revenue and operating income. Revenue in blue, operating income in orange. You can see that now $2.4 billion in operating income over the past 12 months. So expect that to go up because we're lapping a quarter when there was negative operating income. Still not a great margin. You're going to be in about that 10% margin range. That should be able to double or triple in time, but we're not there quite yet with Alphabet. They're still kind of in investment mode. But again, if this continues to grow and the compound annual growth rate is a little bit crazy at 32%, if they're able to keep that in excess of 25%, maybe 30%, that would be a phenomenal growth rate for a business that's already doing $35 billion in annualized revenue. And like I said, this is where artificial intelligence is going to be housed. So Google's strategy in artificial intelligence is basically to do a lot of the things that other companies are doing in-house. They're not buying NVIDIA chips at the same rate that a lot of their competitors like Microsoft, like AWS, like Meta Platforms, like AWS are. They're building their own chips called TPUs, and they have now trained their latest artificial intelligence models on their own TPUs, and they're running those inferences on TPUs as well. So a little bit more of a vertically integrated setup, the way that they're doing this, at least in the cloud. I think that's kind of the way to look at these different cloud services. Is that Alphabet is going to be the one vertically integrated company. They're going to develop their own models. They have their own chips. And so those are the things that they're going to be selling to customers. They have said in recent conference calls that they've had really good traction with startups. But again, we'll see if that is the case. Startups are really what drove the growth of AWS in the mid 2000s. And then as smartphones started to proliferate in the late 2000s, early 2010s. Most of those companies were built on the back of AWS. So who's building the infrastructure behind artificial intelligence tools and applications in the future? If the answer is that Google is taking a disproportionate share of those customers, that is going to be phenomenal for the long-term growth of this business. But again, we're just looking for evidence of, is that the case? Because if they can keep up a 30% growth rate for years, maybe even a decade, this could be an absolutely enormous business. So that's really the upside. Again, my initial focus is going to be on that search business, the core business, because if we have evidence that AI is not disrupting that core business, I think that would be phenomenal for the company, phenomenal for the stock. Shares are still only trading for 23 times forward estimates. So if they beat estimates, they show that that core business is really strong, maybe even grow a little bit more than expected in the cloud business. Wouldn't be surprised to see that forward PE multiple go up a little bit as expectations increase for Alphabet. So a lot to go through, and I will cover more on this channel later in the week. But let me know what you are looking for in Alphabet and the Google business when results are reported after the market closes on Tuesday. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.